Hello, welcome back. So AMD came out with its earnings report and things in the market are looking rosy. The stock is up about 4.5% right now. But there are a few things to consider here and some dangers that I wanted to point out. Now, if you see this report over here, this is the CNBC report, you will see that AMD beats on sales and profit but warns of a 10% revenue decline in Q1. And what is very interesting is this report. The EPS of the company for the quarter is 0.69, that's adjusted, versus 0.67 that was expected, and a revenue of 5.6 billion versus 5.5 billion that was expected. Now the key term here is adjusted. So what does that mean? When we're talking about adjusted, it's basically non-GAAP. And non-GAAP is the generally not acceptable pretty much accounting principles. And so this means that there were some adjustments here to reflect the company's operations in order to make it more fair potentially for investors to understand what is going on. But is it really more fair? This is what we're going to examine, of course, in this video. And this is what I wanted to point out. And you make your own decisions, of course. Now, it's also important to see that the analysts guided to a 10% decline in year-over-year sales in the current quarter. And it looks like, as you'll see here, AMD, it expects 5.3 billion in sales in the current quarter, slightly lower than their estimates of 5.47. That's a suggested 10% decline in sales. Now, AMD's sales did rise 44% in 2022, so the company does do well in terms of sales. This is obviously very important. But what exactly has happened here in terms of the adjusted EPS? Is that correct? Or there is something more behind the scenes? And there indeed is. So let's take a little bit of a closer look here. Now I'm going to take you here to the AMD investor relations page, and as you'll see, they start with saying that they had a record full-year revenue. Obviously, this is also sort of like a marketing page over here. But if you take a little bit of a closer look, you will see this little table here, which has the GAAP and the non-GAAP quarterly financial results. Now, they obviously do have to mention the GAAP ones, but they also mention some adjusted results. As you'll see here, the earnings per share for the GAAP ones are just 1 cent. This is the Q4 2022. And if you take a look at the non-GAAP, is 69 cents. So why this huge difference? So 1 cent to 69 cents is a massive difference. And if you take it to the year over year, the previous quarter over here, you will see that this is down 99% from the previous quarter and just 25% from the non-GAAP results. And again, if you take it back over here, you will see this is all positive here. This is all about pretty much positivity, 69 adjusted versus 67 expected. And again, this is the adjusted ones, so this is better than expected because the expected was 67, so all these things were accounted for. But what has caused this earnings per share to plummet if we're talking about the GAAP results, which is basically the generally acceptable accounting principles. So this is basically the standardized version, and this is sort of like the how to present it for a more for a better version to investors here, how to make a better version and present it in a more delightable fashion for investors. So what has happened here? Let's take a little bit of a closer look here at the PowerPoint, and this PowerPoint that AMD has released. And this is a very nice one, and obviously again this is a marketing PDF, a marketing PowerPoint over here. Sort of, it's a PDF actually, slides sort of like. And of course, you're going to be having all these nice pictures here telling us about how they are the leader and how great they are doing. And they are doing pretty nicely. But if you read between the lines, you can see some interesting things here, some interesting facts. And of course, yeah, we do know that the revenue has been increasing very nicely over here. And you can kind of see it in these slides. Yet the gross margin seems to be going down a little bit due to amortization of Xilinx acquisition related intangible assets. And you do get an operating expense hit when you're amortizing pretty much operating assets. So assets that are related to your daily operations pretty much. And so we are looking at this Xilinx acquisition here, pretty much diluting our margins. And if you take a look at the operating income, there is even more dilution here. You see the gap from 3.6 billion to 1.3 billion, and the non-GAAP is a much different story. Driven by higher revenue and gross margin expansion, yes, but this operating income decreased primarily due to amortization of Xilinx acquisition related intangible assets, and this is pretty massive decline here and pretty massive amortization expenses over here. And the same thing, take a look at this one, what I told you about earlier. Operating income loss over here, summary Q4 2022. As you'll see, due to amortization of Xilinx acquisition-related intangible assets, and the net non-GAAP operating income was pretty much much higher when you're talking about the non-GAAP again. And the same thing with the earnings per share. Again, the non-GAAP much higher because of what happened with Xilinx. And if you are not aware about this one, you will see here that AMD closes record chip industry's deal with estimated 50 billion purchase of Xilinx. And this is obviously a pretty high price tag here, and caused this significant decline over here in the GAAP metrics, at least for the company. Now, if you'll see here, I'm taking a little bit of a look at some quarterly earnings of the past. I wanted to see what happened. And you'll see that the company had a purchase consideration of $48.8 billion for Xilinx over here, and kind of breaks down what happened. Some went to pretty much outstanding shares, and this is why you are looking at a massive dilution of outstanding shares. And of course, you can find all the details at Edgar. That's the website where all the reports are pretty much released. This is a government website, and you can see the current report in more detail if you are interested. But I did want to point this out because it's very important for the company, and it does play a massive role in the company's, as you'll see here, the company's dilution. Now, this earnings report is still new. There is a little bit of a glitch here I'm seeing with the price to free cash flow, but it doesn't really affect our valuation. But you will see that the outstanding shares of the company have been getting increased, and you'll see massive dilution at 65%. Now, if I'm taking it to our stock evaluator here, our stock evaluation tool, you will see that the revenue growth of the company has been tremendous through the years, but of course this is not going to continue forever, and we do expect a decline in the upcoming quarters. So we're going to go significantly lower. Let's go something like 8, 10, and 12. And in terms of the net income margins, again, they're a little bit all over the place. This fiscal year seems like they were significantly lower. But typically the company does something like 20%, so I'm going to still be conservative, but I'm going to try a few different values, 15, 20, and 25, just to have a little bit of a spread here. And in terms of the free cash flow margins, again, we have a little bit of an issue here with the free cash flow. This is a temporary glitch, but it doesn't really affect us. So the company has been doing something like 80, 100. So we're going to go 80, 100 here, and 90. And the annual return, and 100 here, 90, and the annual return that I'm actually looking for typically is 13%. And when I hit calculate, you will see that only for pretty substantial revenue growth and net income margin that is also substantially higher than what the company typically does. Now, they have done this one like 2 years ago or so, but this may be a little bit too aggressive here. Then we're looking at 32, 53, and 80 for the very aggressive scenario, which I frankly don't think it will play out. This probably makes the most sense here for the medium case, and even that is potentially a little bit aggressive. The low and medium probably make the most sense. But this would have to be something near $40 over here. And again, if we go back, there are some other metrics here that are important, the things that I talked about, like the outstanding shares have been getting increased tremendously. So there is massive dilution going on here for the company, which I don't like. Obviously, this is a company that has been growing greatly, but this dilution is insane. And a lot of dilution had to do with this Xilinx acquisition that we talked about. The Xilinx acquisition had the company actually issuing stock, issuing quite a big amount of shares actually, and also this amortization that is going to be happening through the next few years is going to play a significant part on the decrease of the company's net income. And so you're going to be looking at non-GAAP metrics that are going to be significantly better, but the GAAP ones are going to be affected negatively. And as you can kind of see a first pass here, this is a company that I can't see myself getting into at this current valuation. And based on the dilution that has been happening, this would have to be even significantly lower than 40, I think. And I think I would be potentially willing to maybe get it at like $30, something of that sort. But where it is right now at 75 and actually going to almost 80, it's very expensive for what it is. And again, it's important to read through the lines and see what is happening with the company in more detail, because it's easy to just take a look at this report here and be like, okay, things are looking fine. Yeah, there's a little bit of a decline here, but the company has been increasing their revenue at a tremendous pace in the past. So, this is looking great, but not so much. I mean, you kind of have to, actually kind of have to include for all this things that are going on in the back scene pretty much, and they may not be too obvious to investors. So hopefully I gave you some insights here and it helps you a little bit. Please leave a like if it did, and also remember to subscribe if you are new around here. And of course, all our patrons have access to the tool that I used earlier, and you can use your own discounted cash flow models and everything that the tool offers. There's a ton of things here on our tool, and tons of new things added pretty much all the time. But thank you for watching. I'll see you soon. Bye bye for now.